Liquidations are a normal but painful part of leveraged trading. They happen when a trader's position is automatically closed by the exchange because there's not enough collateral left to cover potential losses. To understand how this works, let's start with leverage. Leverage allows traders to borrow funds from an exchange to open a larger position than their actual balance. For example, with 5 times leverage, $1,000 in your account lets you trade a $5,000 position. If the price moves in your favor, profits are multiplied. But if it moves against you, losses are multiplied too. Every leveraged position has a liquidation price, the point where your collateral, or margin, is no longer enough to keep the position open. When the market price hits that level, the exchange forcefully closes your trade to recover the borrowed funds. At that point, you usually lose nearly all of your margin. The higher the leverage, the closer the liquidation price sits to your entry price, which means even a small market move can wipe you out. That's why extreme leverage, like 50 times or 100 times, often leads to fast liquidations during volatility spikes. Now, let's compare liquidations to stop losses, because many traders confuse the two. A stop loss is a planned exit that closes your position automatically at a specific price you choose. You lose some of your margin but keep the rest. Liquidation, on the other hand, is forced. You lose your entire margin and possibly pay additional maintenance fees. Here's a simple example. Say you open a $100,000 position using $5,000 in margin at 20 times leverage. The exchange requires a 1% maintenance margin, meaning you need to maintain at least $1,000 in equity. If price drops enough that your balance falls below $1,000, liquidation is triggered and your position is closed automatically. If you had placed a stop loss just above that level, you'd take a smaller controlled loss instead of losing everything. Liquidations serve a purpose. They protect the trading system and ensure the exchange can pay out profits to winning traders. But for individuals, they're a sign of poor risk management. To reduce liquidation risk, use lower leverage levels. Always place stop losses well before your liquidation price. Maintain extra margin in your account. And be aware of price slippage, since orders may not execute exactly where you expect. In short, leverage increases opportunity, but it also increases risk. Liquidations are not random. They're simply the result of running out of margin. Use leverage carefully and plan your exits before the market plans them for you. Thanks for watching. If you've got questions or thoughts, drop them in the comments. We're happy to reply. At Mudley Group, we're building a space where anyone can learn trading, improve together, and feel supported, whether you're brand new or already trading. Follow the channel, like the video, and check the description for useful links. See you in the next one.